What if I told you that Apple, a company worth nearly $4 trillion, is just getting started? You've seen the headlines. The stock is at an all-time high. But the real story, the one that will determine if this is the best buying opportunity of the decade or a catastrophic bull trap, is hidden in the numbers. And today, we're going to expose it all. In a world of financial noise, let's find the signal. Welcome to Smart Money Sense. Apple is on an absolute tear. The stock just smashed through its previous records, fueled by unprecedented demand for the new iPhone 17. But hype doesn't equal a smart investment. In this video, we are doing the ultimate deep dive, a complete financial analysis of Apple stock as of October 2025. We will dissect their latest earnings report, uncover the real strength of their services division, analyze the bullish price targets from Wall Street's top analysts, and confront the serious risks that could send this stock tumbling. By the end of this video, you will have a clear, data-driven understanding of where Apple is heading next. Let's get into it. So, what's behind this incredible rally? It's a perfect storm of positive catalysts. As of this week, Apple's stock surged past $262 a share, pushing its market valuation to a breathtaking $3.9 trillion. This wasn't a random spike. It was a direct response to a report from Counterpoint Research showing that initial sales of the iPhone 17 have outpaced last year's iPhone 16 by a staggering 14% in the critical markets of the US and China. Think about that. In a competitive market with economic headwinds, Apple convinced 14% more people to upgrade. The base model iPhone 17 in particular has been a runaway success, with sales jumping by nearly a third. Why? Value. Apple packed it with a better chip, an improved display, and a camera upgrade, all at the same price point. Chinese consumers, who are notoriously value-conscious, are rewarding them for it. This directly counters the narrative from earlier this year that Apple was losing its grip on China. The king is back. But the iPhone is only one part of the story. This momentum is built on years of strategic decisions that are now paying off in a massive way. All right, let's pull back the curtain and look at the raw numbers from Apple's third quarter 2025 earnings report. This is where we separate fact from fiction. The company reported a quarterly revenue of $94 billion. That's up 10% year over year. In this economic climate, double-digit growth for a company of this size is phenomenal. Earnings per share, or EPS, came in at $1.57, a 12% jump. But the devil is in the details. Let's break down the revenue by segment. iPhone revenue hit $44.6 billion, up 13%. This confirms the iPhone 17 sales data we just talked about. Mac revenue was also strong, hitting $8 billion, up 15%, likely driven by a new product cycle. However, not everything was perfect. iPad revenue was down 8%, and the wearables, home, and accessories division, which includes the Apple Watch and AirPods, also dipped by 9%. This suggests some softness in consumer spending on non-essential gadgets. But here's the most important number on the entire report, the one that gets long-term investors excited. The services division. It brought in a record-breaking $27.4 billion, up 13%. This is Apple's secret weapon. Why do I call services the secret weapon? Because it's a high-margin, recurring revenue machine. This isn't just about selling a phone once, it's about the App Store commissions, Apple Music subscriptions, iCloud storage, Apple TV Plus, Apple Pay fees, and Apple Care warranties. It's an entire ecosystem designed to generate consistent cash flow long after the initial hardware sale. With an installed base of over 2 billion active devices worldwide, every single one of those is a potential recurring customer. The 13% growth in this segment is a massive signal that Apple is successfully monetizing its user base. The margins on services are also significantly higher than on hardware, meaning this growth is incredibly profitable. It's this predictable high-margin revenue stream that justifies a higher valuation for the company and makes it far more resilient than a simple hardware maker. And here's a quick but crucial point. If you're finding this breakdown of Apple's business model useful, do me a quick favor and hit that like button. It's a zero-cost way to support the channel, and it tells the YouTube algorithm that we're delivering valuable insights. It helps us a ton. Thank you. Now, let's look at what the bulls and bears are saying. First, the bull case. Wall Street is overwhelmingly positive right now. Wedbush analyst Dan Ives has a price target of $310, citing what he calls a super cycle of iPhone upgrades driven by AI features. Loop Capital is even more bullish, with a street-high target of $315, implying another 25% upside from here. Goldman Sachs and Wells Fargo have also raised their targets to $279 and $290 respectively, both expecting a blowout fourth quarter. The bulls believe the market is underestimating the long-term value of the services division and the stickiness of Apple's ecosystem. They also point to the company's massive $110 billion share buyback program, which reduces the number of shares outstanding and boosts earnings per share. But what about the bears? What are the risks? This is what you need to pay attention to. The biggest one is geopolitical tension. New tariffs on goods from China could cost Apple over $1 billion. The company is actively moving some production to India to mitigate this, but it's a slow and expensive process. Second is competition. While the iPhone 17 is a hit, Chinese competitors like Huawei are not standing still. Earlier this year, Apple saw its sales in China drop significantly before this recent rebound. That threat hasn't disappeared. And finally, there's the innovation question. While Apple is investing heavily in Apple Intelligence, some critics argue it's still playing catch-up to Microsoft and Google in the generative AI race. Future growth depends on their ability to integrate meaningful AI that convinces people to keep upgrading. Okay, we've covered the fundamentals. Now let's get technical and look at the AAPL stock chart. The stock just broke out to a new all-time high of around $263, which is now our key level to watch. A sustained move above this is extremely bullish. The prior resistance level was around $255, which should now act as the first line of support. If the stock pulls back, the next major support zone is down around $240. Looking at the indicators, the Relative Strength Index, or RSI, is sitting around 56. That's in neutral territory, meaning the stock isn't overbought yet, even after its recent run-up. The MACD, another momentum indicator, is showing a bullish crossover, which supports the case for more upside. Fundamentally, the valuation is high, but not absurd for a company with this level of growth and profitability. The price-to-earnings ratio is around 40, and the forward PE is 34. That's pricey, but you're paying for quality. The PEG ratio, which factors in growth, is over 3, suggesting the price has gotten a bit ahead of the expected earnings growth. This is a metric to watch, so the technical picture is strong, but the valuation suggests that a lot of the good news is already priced in. So, after all this analysis, what's the verdict? Is Apple a buy, hold, or sell in October of 2025? Here's my synthesis. Apple is firing on all cylinders. The iPhone 17 has silenced the doubters, proving the company's brand power is as strong as ever. The services division is a high-margin juggernaut that provides a stable, growing foundation for the entire business. The company's balance sheet is a fortress, with over $65 billion in cash and a massive capital return program rewarding shareholders. However, the risks are real. Geopolitical tensions are a wild card, and the stock's valuation is stretched. At these levels, the stock is priced for perfection, meaning any misstep in execution or a negative turn in the macro environment could lead to a sharp pullback. For long-term investors, Apple remains a core holding. This is a blue-chip innovator with an unparalleled ecosystem and brand loyalty. Buying on dips has historically been a winning strategy. For traders or those looking to initiate a new position, the decision is more nuanced. Chasing the stock after a massive run-up is risky. A more prudent approach might be to wait for a pullback to a key support level, like the $255 or $240 mark, before starting a position. The upcoming fourth quarter earnings call on October 30th will be a major catalyst. We'll be listening closely for guidance on the holiday season and any further color on the iPhone 17's performance. Before we wrap up, I want to know what you think. Is Apple going to $300, or is a correction coming? Let me know your price target in the comments below. I read every single one. And if you're serious about making smarter financial decisions, make sure you subscribe and hit that notification bell so you never miss a deep dive. You've just gotten one step smarter. To keep building your financial sense, watch this video next. And subscribe so you never miss an insight. This is Smart Money Sense.